To give us some background, can you tell us what a QDIA is?
Yeah, it's a qualified default investment alternative. So what that really means, though, is it can be included on a retirement plan menu as the default. Many people, when they sign up, have no idea what to select, and so you have to give them something. And so that menu is part of the Pension Protection Act of 2006, expanded to include target date funds. So that's a lot of the reason we're talking today is because of that expansion they did in 2006.
Okay, and just to make sure listeners are on the same page, what is a target date fund?
So a target date fund is a basically a one-stop shop for investors that are planning for their retirements, right? There are all sorts of different asset classes that investors might want to have as they save for retirement. And a target date fund is designed to do that asset allocation for you. So it'll do your mix of stocks and bonds, and it'll actually change to evolve over time. So if you're retiring in 2060, you can buy a 2060 retirement fund, target date fund to basically fund your retirement. And then every month you're just putting money into that same
Hmm.
fund and the fund's taking care of the asset allocation for you.
And how significant are target date fund holdings in American retirement accounts today?
Increasingly more and more so. I think they're about half of retirement accounts now. That's been increasing over time. But I think the big number to look at is on a monthly basis as people are contributing, over 70% of the money is going into target date funds now. Yeah, it's really significant. And if you look at younger people, people that started with them as the default options, most, if not all of their assets are in a single target date fund, which is exactly how the product was designed. So it's doing what we wanted it to do. But it also means these target date funds are having an increasingly important space in the retirement landscape.
Hmm. Can you talk in general terms what like you mentioned that they changed the mix of stocks and bonds over time. What does that glide path typically look like?
The idea of a glide path is that you're going to decrease the amount of risk you take over time. So you might start out, 20 years old in your first job, saving into your retirement plan and almost entirely invested in stock, with this whole idea of stocks for the long run, right? And there's all sorts of life cycle portfolio choice models built around this. And the vast majority of them kind of indicate you should take more risk early on because you have a lot of kind of human capital in your own income you produce. And then as you get older and you have less time to work yourself, you shift into safer assets like bonds. Obviously, there are lots of kind of counterpoints that come in on that, but I think that's the generally accepted wisdom today. And so you're going to see that mechanical decrease in equity exposure or risk as you age and get closer to retirement.
Why is it difficult to benchmark or even compare target date funds?
Because they all do it a little bit differently. Each of the different target date fund providers, and here you think Fidelity, PIMCO, T. Rowe Price, Vanguard, they all have all sorts of different choices they can make, right? One choice is what does that glide path look like? How much equity do you start with? And then how quickly do you decrease that equity mix over time? So that's going to be one big choice. Another big choice is going to be, well, within the equity bucket, how do you slice that up? Do you do, a mixed domestic and international? And then if you do domestic and international, do you do even more sub-asset classes? So do we start doing, small, medium, large, value and growth all within the US? And then outside the US, start thinking about developed versus emerging markets? Or do we split, developed markets into Asia Pacific and Europe? You can go kind of on and on. And what you'll see is that some fund companies decide to put 30 different mutual funds in their target date fund. Others tend to do four.
Hmm.
So there's vast diversity in how that is accomplished. And then as one more, how are you going to manage that glide path through retirement? This is one of the classic ones is the to versus through retirement, because to retirement almost assumes that once you hit, 2060 or, 2025 for those retiring this year, the idea was that you would take your money out. Well, fund managers don't like the idea of losing their assets under management. And so then through retirement plans came out. And so the idea is that they're going to continue managing that asset allocation mix all the way through your retirement. So, you invest in this thing when you're 20 and you hold this thing until you die, basically. That's kind of the asset management industry's plan on it.
Hmm. Yeah, it's really interesting. We don't have a big target date fund market in Canada. It's just not not developed in the same way that it has in the States. So I hadn't thought a ton about it, but just the fact that they have different glide paths and the fund companies will even try and differentiate themselves by having a better glide path. It's super, super interesting. Didn't really realize any of that.
Well, and
Uh,
then one other layer is that the fund companies almost exclusively hold their own funds. So it's not
right.
like Fidelity is looking outside of Fidelity for mutual funds to hold. They're pretty much looking exclusively at Fidelity funds. So is Vanguard, so is PIMCO, so is BlackRock. All the big players do this, and there are very few that will actually deviate and try to
Mm,
pick, the best funds from different fund families. And so as a result, you end up with kind of a beholden fund structure where you have to use Fidelity funds if you're in the Fidelity plan.
right. So how do you approach benchmarking target date funds in your research?
So what we found when we started looking at this is there's no great benchmark. Part of it is because of these different asset allocations, different funds. I mean, I didn't even go into different fee structures, but it all makes it very hard to compare. And so our premise is that, these are funds of funds, right? They're holding other mutual funds in them for the most part. And so what we can do is look at those underlying mutual funds and map them to a set of common assets, right? Again, I mentioned kind of, US equities versus international equities or large cap versus small cap, right? We have a pretty good way to benchmark those funds, and those are index funds, right? This has been a big part of the literature of comparing active to passive management for a long time. And so our basic idea is if we can take any given fund that a target date fund holds, map it to an index fund that it best replicates, right? We're going to think about replicating funds here. Then we can take those underlying passive index components, build them back up into the same portfolio with the same asset allocation, and now we have a replicating target date fund. So essentially, it's a custom benchmark built to each individual TDF if you were to make that TDF as a passive product.
Yeah, okay, interesting. So it's taking the glide path of the asset allocation as sort of given and then comparing the underlying funds to index funds rolled up to the asset allocation.
Yeah, exactly. You could think about it as measuring kind of the operational efficiency of the target date fund, right? We're taking the glide path as given, and we can talk more about that as we keep going, because that necessarily means that some of the value that these TDF managers are adding, we're not giving them credit for here.
Right.
We're
Yeah.
just saying, given that you picked your asset allocation, how well did you basically deliver on it
Yeah.
relative to what you could do with a very cheap passive product?
Right.
Right. Yeah, makes sense. How confident are you that the replicating ETFs that you're choosing or index funds that you're choosing are actually good representations of the underlying asset class funds in the target date funds?
Overall, I'm very confident
Hmm.
at the TDF level. And that's because we can run, regressions and correlations and look at how well do those replicating fund returns match the TDF returns. And on average, it's 99.7% kind of match. Oftentimes it's 99.9, but we do get situations where the match is not great, right? You could think about, for example, a commodities fund. In our first iteration, kind of our baseline specification in the paper, we match all the underlying funds to a set of Vanguard index funds and ETFs. So we use both index funds and ETFs. That way we show it can work either way, but it's really just 50 funds. And in that mix, Vanguard did not have a commodity fund at the time. And so as a result, you can get a commodity fund that Fidelity is offering that really doesn't match very well to anything. This example, I think we had like a 60% correlation or a 0.6 correlation rather. And so the match is not great. However, commodities are usually a very slice of the portfolio. So when you aggregate that up, really it kind of washes out at the end of the day. Now, that's not a perfect answer. So what we actually do is kind of an extension is we say, let's just take the entire ETF universe. Say that you could use any ETF to match this to, because there's pretty much an ETF for any asset class. We get much better individual matches, and the overall results of the paper do not change at all. So at the end of the day, we don't think it's something that matters significantly as we get the whole feeling of the industry.
Hmm.
How much tracking error do your replicating funds have relative to the target date funds?
Like I said, for the most part, it's very, very minimal, right?
Hmm.
These things are tracking 99.9%, 99.7. We do see some interesting differences come up, though, that we had to address in the research. One of those is that when you build up a replicating fund, you're not going to have the same cash drag that a target date portfolio has to deal with, right? Just the fact that they have money flowing in and out through redemptions and, new money coming in, they have to keep some cash on hand to manage that. Oftentimes it's 2 or 3% of the portfolio. And so if we don't replicate that cash piece, then we're going to actually have better returns when markets are up, right? You just have
Mm.
more risk exposure and less when markets are down. So we get basically a little bit more beta in ours than we would get otherwise. But again, we can adjust for that when we're doing the analysis.
Okay. And do you adjust for that? Like, do you add a cash allocation?
So we do two different types of analysis here. One, we do it with the replicating funds, and there we don't add the cash piece, but we also do the more traditional beta and alpha type asset
Okay.
pricing analysis, and that's where we account for it with that beta piece.
Okay, got it.
So
So,
yeah,
how do the target date funds perform relative to the replicating benchmarks?
so on average, and this is all in the original paper we wrote that ended in 2019 for our sample. It was about 1% per year is how much they underperform these replicating fund benchmarks. And 1% a year, you know, I think most of the listeners here understand that that's a big deal, but especially it's a big deal when you're thinking about retirement horizons,
Mm,
right? If you're 40 years out from retirement and you're thinking about maybe 20 or 30 years in retirement, 1% a year for 60 or 70 years is half your money. So it's a really significant amount that we're talking about here.
And what are the main drivers of this underperformance?
So there are two big drivers and one small driver. The biggest driver is fees. So there's no surprise here for that 1%, about 55 basis points of that is higher fees on the TDFs. And these are incremental fees. So the replicating fund itself has index fund fees built into it. So it's fees over and above that. And those are really coming from two sources. One is the underlying mutual funds. Many times they are active, and so they're just going to have higher fees. And so just focusing on the fee piece is going to pick that up. The other piece is TDF level fees. So these are funds of funds. And so the TDF will also charge a fee on top of the
wow.
underlying funds management fee. Now, that's not always the case. Some funds will charge no TDF fee, some will charge no fee on the underlying assets, so they'll use zero cost share classes. And that's another way that I think the TDF companies play this game a little bit of how they present their fees. But at the end of the day, 55 basis points is from that fee piece. Now, the other 45 basis points, that's coming from poor active management. So if we just look at gross returns, so take the fees out of it now, the active funds underperform those passive benchmarks by that 45 basis points on average per year, right? Again, and that's before fees. We want to find active managers that are actually at least breaking even and covering their expenses, but those are not the funds that have traditionally been placed in target date funds.
Wild. So they're underperforming gross of fees and then obviously even more so net of fees.
Exactly. And then there's
Jeez.
a small third piece that is timing.
Hmm.
So when we're doing our analysis, this is all based on the holdings that the funds report. So the TDF reports their holdings at the end of each quarter. And so what they do between the quarter, we can't really see. They're making, tactical asset allocation decisions. They're rebalancing. And so ultimately we have to choose a benchmark here and we choose to rebalance monthly and we're going to update the holdings quarterly. So to the extent that they're rebalancing differently than that, and they're also making shifts in the asset allocation that we don't see, that can either add or subtract value as well. And on average, that's about a couple basis points per year. So not really significant one way or the other.
Okay, makes sense. Yeah, so it's really the underperformance of active and then add on the higher fees.
Exactly.
Not surprising, I guess, but not good news for target date fund investors. How have those costs evolved, or how do they evolve over your sample period? Like, are
Yeah.
costs
So,
getting lower, or is it improving?
so there is some good news there. I guess there's good news and bad news. So the good news is that the costs of TDFs have come down quite a bit over time, just like we've seen in the passive fund space and the active fund space for that matter. So right, whereas on average, I think the average fee a decade ago was like 60 basis points ish. Now it's down into the 40 basis points
Hmm.
range. So it's certainly improving. However, it's not necessarily all getting better. So we don't have a current number on the recent decade, just since we haven't updated the academic paper. But this actually brings me to something that my co-author and I have done. And that's that we think it's really important for investors to have access to this kind of data on their fund, right? As academics, we do research with data that we all kind of get from a university license, and we can't take that data and put it on a website somewhere. So my partner and I, Sean Davies is my co-author at Colorado. We actually started a company where we're able to buy the data to provide it to people.
Oh,
So
wow.
the website is glidepathfinancial.com, but you can go there and basically look up whatever your TDF is and see how it's performed over the last 5 years. And so good news again is that a lot of funds are doing well, and generally that spread has come down. The bad news is there's still huge disparity between the best and worst performers, right? If you look at, BlackRock over the last few years has done really well, and oftentimes they'll beat their benchmark by sometimes more than 1%. And on the flip side, we have, T Rowe or American funds that are lagging it by more than 1%. So you can see, 3% difference in kind of relative performance from the best to the worst performers, which, we talked about 1% being big, 3% is massive.
Wow.
That's nuts. So there's significant, like very, very significant dispersion between the best and like given a retirement date, if I understand correctly, the best and worst target date fund performance is like materially different.
Yeah. And actually, I'm going to go back to a paper by Balduzzi and Reuter. They have a 2019 paper in the RFS that looked at this, kind of first documented how much dispersion there was. And obviously, this is cherry picked, but there was 1 month in which, if you compared TDFs within a given vintage, the difference in the monthly return, right? 1 month return between the best and worst performers was 23%. Like,
Yeah, that's nuts.
dumbfoundingly huge. But because they're taking against so many different kinds of bets in different ways, there's a lot of scope for this dispersion in performance that really hasn't gone away over time.
Wild, yeah. So that's like a whole other risk for target date fund investors. It's like on average, you've got the drag, but you could end up in one of the worst performing target date funds, or I guess one of the best ones.
Right. And I was mentioning some companies here. When we wrote the original paper, Fidelity, they were kind of an underperformer by about 1% per year. If you look in the last 5 years, they're overperforming by about 0.5% per year. And again, this is kind of averaged over
Wow.
vintages, and again, different time periods. Fidelity is a fairly active shop, and that's where a lot of their kind of outperformance is showing up. So for a good period of time, they underperformed. Now they seem to be overperforming based on this type of benchmarking. Now, what are they going to do for the next 60 years? Who knows? But that kind of volatility is something that you're going to get when you have more of this active management.
Right.
And do you find any evidence that the plan sponsors or investors are aware of how their target date funds are actually doing?
Not really.
Wow.
So the way we approach this is to look at fund flows or the assets under management. This is a traditional approach in the academic literature that we can say, when a fund does better, it tends to attract more inflows. More people want to invest with a manager who's producing alpha. And so we can say, all right, when the TDFs do better, based on this measure relative to this benchmark, do they attract more money or do they lose more money when they do worse? And generally, there's no sensitivity to it from investors. And investors, I think you hit on this, Cameron, but it's not really the investors that always have the choice, right? You're in a 401k plan where most of these assets are, you really only have access to one TDF, right? You might have access to different vintages. So you can pick whether you're in the 2025, 2030, 2040, et cetera. But you're not going to have a Fidelity and a Vanguard product right next to each other, at least not very often. And so if you're going to change, it's usually somebody in your HR department that has to start that process going forward, or a plan sponsor that's going to go ahead and say, okay, we're going to shift everyone from, sponsor X to plan X to plan Y. So even there, though, we don't see a lot of evidence that those big shifts are happening in response to this performance.
Interesting. So yeah, it's not the individuals, it's the plan sponsor that have to make the change, but it doesn't seem like they're following your benchmarking methodology to say, hey, maybe we should change fund providers.
And I think a lot of that's because this is not trivial analysis to put together.
Right.
Right. It takes a bunch of academic analysis to be able to understand how should we construct these portfolios, actually do it, and then, like I said, try to make it available so people can make decisions off of it. Right. We too often in academia, we're very much in our ivory tower of let's figure it out. and then we'll tell the other
Yeah.
academics about it through our finance journals. But we need ways to disseminate it and push it out to practitioners who can make decisions based on this data now. And so that's why we have our website.
Okay, so I want to come back to the benchmarking methodology and how it holds the glide path constant. What do you think about the argument that an actively managed fund family, like say it's Fidelity or whatever, with a better glide path? I was actually reading some Fidelity TDF literature recently, and they talk about their belief that they should have investors should have higher allocations to equities.
Mm-hmm.
So Fidelity says, okay, we need a higher equity allocation. And I know you said that they're outperforming based on your methodology, but even if they're underperforming relative to an asset allocation held constant benchmark, they might be outperforming relative to a more conservative target date fund. So, like, how do you think about that?
So I think the first step is that we don't have to think about active glide paths as necessarily being active underlying funds.
Hmm.
Right? Fidelity offers a number of products. And so you could go to Fidelity and use their Fidelity Freedom Index product, which is going to be just index funds. So you can go Fidelity Freedom, which is the active funds, or you can go Fidelity Freedom Balanced, which is going to be a mix of the two.
Hmm.
So you can make these two decisions independently, basically. You can kind of pick your risk level through the fund family and then pick whether you want the active or passive implementation of that glide path. So it's not really a fair choice to say those are necessarily coupled. That said, it could be that active fund managers, some TDFs are actually more active in managing their glide paths than others, and we'll get to that in a minute. So the other big consideration is that we really don't know what an optimal glide path looks like. In the academic literature, there again this general consensus that it should be downward sloping, so less risk over time. But some people have proposed it could actually be upward sloping. And one of my colleagues here at the University of Arizona, who's been on your show recently, argues for essentially an all equity retirement portfolio split between domestic and international funds because of some long-term return properties. And it's a fascinating paper by Scott Cederberg and co-authors. But essentially, the jury's still out on what the optimal glide path is. And so while you might think you want a riskier glide path, sure, you can go for that. You can clearly see some are going to have more risk than others. But again, I think that can be separated out from how active your manager is at the end of the day.
Yeah. Okay. Interesting. So, and this is, like you said, we don't know what the optimal glide path is, so it's a bit of a tricky question to ask. But if we believe that a higher equity allocation is good, as Fidelity suggests it is, and as Scott Cederberg's research suggests that it is, what do you think about the argument that the active management in Fidelity's active target date fund actually allows the plan participants to feel more comfortable with a higher equity allocation? It's kind of like the Money Doctors paper in Journal of Finance, where if the end investors trust, even if it's not working, the end investors trust that the active managers are doing something good for them, that allows them to take more equity risk, and that's net a good thing. What do you think about that?
I mean, I think there's definitely something to be said for that. I think there are all sorts of behavioral considerations that have to be accounted for when thinking about target date funds, because these are people making real decisions, not in a vacuum of, an academic model. That said, I think with, the Money Doctor's perspective, the assumption is you're working with somebody that you can trust, right? And you can develop that relationship. In these cases, somebody's picking a plan off of a menu in a 401k and they have no idea whether there's a person doing anything in the background there. So I'm not sure how much it really matters in this setting. There's a small slice of investors who access TDFs directly through a financial advisor. But if you're going through a financial advisor, odds are that they're going to be more actively managing your portfolio, or at least managing the asset allocation more than just putting you in a plain vanilla TDF.
Right.
They could. Hopefully, they're not charging you too much if that's the piece they're doing there.
Yeah, no, makes sense. I'm not. I don't love that argument about active management allowing people to take more equity risk. Like we on this podcast typically advocate for index funds, but it is a comment that I've heard with respect to target date funds. Like, yeah, active management might underperform, but it's going to let people feel more comfortable with more equity risk. Therefore, it could be actually a good thing. But anyway, your comments made a lot of sense.
So in designing an alternative solution, how would you address the dispersion in glide paths across TDF fund families?
Right. So you have all these different TDF families that have, big research teams that they've employed to design these optimal glide paths. And so we have a lot of different people arguing over this. And it's, again, it's fascinating how distinct these glide paths can be. Again, they're generally downward sloping, but they change frequently and they can have very different slopes and they're all over the place. And so my perspective on this is we have a bunch of people. Let's use the wisdom of the crowds. This has come up in lots of other contexts and shown to work well. So essentially, if you take the industry aggregate asset allocation and use that as a way to drive a TDF, I think that could actually be a very valuable product. And that essentially you're indexing the indexers almost. And you're taking the index fund idea to an asset allocation level rather than to an individual asset class level, which has been kind of what's been very successful up to this point.
That's a super interesting idea. Do you asset weight that or just equal weight the allocations of other target date funds?
I think there are a lot of questions on how you want to do it.
Okay.
I mean, the first level question is, do you give Vanguard 40% of the weight? Right? Vanguard is a very particular asset allocation. They use 4 to 6 funds rather than many of the sub-asset allocations. So again, they're just going to be very high level. They have 40% of the assets. They're generally on the conservative side. And so I think that's where, actually some careful thought can be put into it. And we actually might see multiple index providers come out with something like this that all have a different flavor to them. Because the other big question is, how quickly do you react to the industry? Because like we'll talk about in a minute, some of these funds are changing their glide paths very frequently. And do you necessarily want to be chasing these quick changes in asset allocation if you're more of a stable long-term index type idea?